Hi, everybody. This is Bennett Sebastian with Envision Construction and Development. This is the third in a series of interviews that I'm doing with commercial real estate professionals that contribute to the built environment that we work and live in. And today I'm talking to Jennifer Pollock with Ameris Bank. She's going to give us a pretty good overview of commercial real estate construction and development financing. Hope you find it informative, and you'll be able to reach Jennifer at her contact information that is provided at the end of this interview. So without further ado, let's go ahead and jump into that interview. Hey, Jennifer.
Hey, Bennett.
How are you?
I'm well. It's Friday, no complaints.
Happy Friday.
Happy Friday.
Yes. Well, thank you for coming on and talking a little bit about this topic of construction and development financing. I know you've got a lot of experience in it, and so I thought of you and thought you'd be a great person to talk to about the topic. So appreciate you coming on and doing that.
I appreciate talking to you.
Yeah.
It's always a good conversation with you.
Yeah, thank you. Well, before we get into the topic, tell us a little bit about how you got into financing, lending, and what your background is, and then maybe tell us a little bit about the company you work for and what their sweet spots are.
Okay. So I don't know if everyone knows, but you and I share a common background. We're both prior military. So I joined, Go Army. I joined the military right out of high school, but that was really for the opportunity to get to college. The Army afforded me a lot of opportunity early in life, and ultimately allowed me to get to UNC Chapel Hill, go Hills. And there I studied business administration and international studies. And my first opportunity out of college was in the banking industry. It was a small North Carolina bank that was looking for folks that other than finance, folks that could string together a good conversation and that were personable, and it was a new avenue they were taking. So I said, why not? So I've been in banking since then. It's been over 20 years now, and I've always been on the commercial side, and for the past decade or so, just on the commercial real estate side, which has been really interesting for me.
So did you take some time off between undergrad and getting your MBA? I know you got your MBA at UCF.
I did. I got my MBA in 2002, so probably 6-7 years into my banking career.
Yeah.
Just looking for that next level, and it helped. It really did help. Yeah. And then of course you and I are both CCIMs.
Right.
As well. Yeah, I have picked up my CCIM in 2014. So
yeah, we've got a lot in common. We've got a lot in common. We both straight out of high school into the Army, both GI Bill, both went to college, worked for a few years, got our MBAs, then got our CCIMs, and neither one of us are in commercial real estate brokerage.
That's right. And look at us.
Yeah, we're doing fine.
We're doing all right.
Well, so tell us a little bit about Ameris Bank and what you guys do.
So I joined Ameris Bank about 1.5 years ago. Ameris is a longstanding bank, but I joined because they came to Central Florida, and I joined to help them grow the market share, grow their capabilities. The bank itself is headquartered in Jacksonville, Florida, and in Atlanta, Georgia. It's about a $20 billion bank, so just sitting in the nice sweet spot of a super regional. We carry locations from Central Florida all the way up through Georgia, South Carolina, and we're well on our way into North Carolina as well.
Okay. And how long have you been with them?
About 1.5 years now. They came to town through acquisition, and have grown primarily through acquisition of smaller banks.
And so to get into the topic of today, which is construction financing, and you do a lot of construction and development financing.
I do.
Is that right? Okay. So how is that different from like an acquisition loan? What are the different profiles of the two?
Well, construction loans, commercial construction loans in general, are one of the riskier loans to make in the industry, and it's really just because you start with a non-income producing asset. You improve it through either land development or vertical construction, and you turn it into something that is income producing that'll allow you to repay the loan. But that interim time between something that it's not and something that it's going to be, obviously, is a risky time. A lot of things could happen that could go south.
Okay.
From the owner to the GC to the bank to the, there's just a lot of things that could happen. So it's a riskier investment.
So it's generally a little more difficult to obtain than acquisition financing that you've already got a building that's built and tenants that are occupying it.
Right. Right. The bottom line is, where's the repayment source? And for construction loans, the repayment source comes a little further down the line than when you start. Whereas with an acquisition loan, you have in place revenue to start repaying immediately. Yeah.
So what are some of the different types of construction loans?
So, you start from the very basic, the land development loans, where you have just raw land and you need to put in the infrastructure to start building or start parceling out. Those are usually called A&D loans, acquisition and development loans, and they're usually for residential builders, large home builders, or large tract commercial developers, where they're going to put the roads in, put the sewer in, and then they're going to parcel it off and sell off individually to others or develop themselves. Once you get past the land development portion of it, you get the interim construction. That's when things go vertical. And that is usually an 18 to 36 month interest only kind of period where things get come out of the ground and CO, get your construction occupancy.
And you're paying interest on the money you're drawing.
On the money you're drawing, yeah. On the money you're using as you're using it, yeah. And then the kind of last end of it is a mini perm. Once the certificate of occupancy is there, once everything's constructed, then it's just a matter of stabilization. If you're an investor, you're in the lease up period. If you're a business owner, then you're really just transferring all of your equipment, your services into getting yourself set up. And then hopefully the mini perm turns into a commercial mortgage, a long-term 25, 30-year commercial mortgage, which is what the bank like.
Are there loans that automatically convert to a perm?
We'd like them to, yeah. I mean, obviously that's the end goal for the bank. The construction part is the risky part, and banks would prefer for those loans to stay long-term. So we both get the benefit of the long-term repayment ability, asset growth there. So yeah, it's the bank's preference to turn a construction loan into a permanent loan that stays with us. It doesn't always happen, but yeah, there are ones. The other takeouts are, other financing sources, HUD, private investors, REITs, all kinds of folks that want to hold the asset long term.
Okay, so talk a little bit about who some of those other financing sources are. You mentioned banks, conventional financing.
Yeah.
What are some of the options?
Well, by and large, most of construction financing is done conventionally through banks, really for the sheer fact that banks are the cheapest source of debt funding. There are obviously private investors that finance, and then there's really just pools of funds that are at a higher interest rate, a higher cost to others. There's government entities, folks like the SBA. We mentioned HUD, financing government. Those are government financing options. They're a little more labor intensive, require a little more in-depth documentation, and take a longer period of time, but they're good resources for those who need them.
So what are the pros and cons of conventional financing versus, say, SBA financing?
Oh, well, so SBA financing particularly is your taxpayer dollars and mine. The SBA provides a guarantee to the bank to entice them to make loans for customers that need the extra leg up, if you will, particularly for business owners, owner-occupied folks. Folks who can't afford quite as much equity down as required. We require between 15 to 30% equity into a project. If a business owner can only afford 10% down, the SBA is a good option. Again, the fees, the documentation, this is all a government process. So It takes a little more time, it costs a little more money, but it is there as a backstop for those for their first project.
Okay. What if an owner, a business owner, let's say, wants to develop a project but occupy a portion of it, and then either sell off or lease up the rest of it? What kind of financing would that entail, and what kind of forward commitments would you look for?
So particularly for a business owner, in order to get, there's preferred terms for business owners that the banks generally look at that, and I'm talking from the banking perspective. Banks generally look at business owner construction or business owner real estate acquisition as a little less risky than investor owned. And think of it like you would take care of your own home before you take care of your investment home. Same kind of idea with the commercial real estate. You need your building to operate your business. That's not usually. So for business owners, there's preferred terms, and if they want to not occupy that entire space, they have to occupy at least 51%, right? To call it owner occupied. Otherwise, it's just an investment property that they have to have a piece of. So it all comes down to bottom line repayment ability. So if a business owner wants to occupy less than 51%, as long as they can afford the full repayment, or they have tenants in place that can afford it, then all is well. It's just a matter of what you call it, whether you call it owner occupied or whether you call it investor.
Okay, so the tenants that are in place, it's not necessarily a certain percentage that needs to be leased up. It's just a matter of getting enough income to cover the debt.
It is. It is.
Okay.
That's the name of the game. Yeah, banks never want to own real estate.
Yep. Yep. Understood.
It.
So what are the uses that construction financing can be applied towards?
So most everything that it has a direct relationship to the real estate itself. So all the hard costs, all the GC costs, all of the eligible soft costs, meaning the permitting, the surveying, the due diligence, the attorney's fees, all of those that actually go into the guts of the project itself. Really, the only ineligible cost from a bank financing perspective are things like leasing commissions, developer fees, really because those should be, first of all, part of equity and occur after the actual certificate of occupancy, right? Occur after the building is built. And so those fees aren't really part of the collateral value of it, although they're legitimate costs.
Okay. What about just overall general requirements to obtain financing? What do you look for, from the borrower?
So we want to know the borrower has thought through what they want to do, whether it's investor or the owner occupied, and we can really facilitate the conversation on that. We're going to make sure that they've thought through the whole process. For first-time developers or first-time business owners who are constructing their own property, this is more of a relationship building conversation that we have with them. But in general, it's the basics, Bennett. It's make sure you have clean credit, make sure you're not over leveraged yourself. You want to make sure that you have a really good team surrounding you, and that goes from GC all the way down to the banker. You really need a good support system that you can trust and folks that you can rely on to do what they say they're going to do on time. And then you just have to have the equity. Honestly, I think the equity is the biggest thing that people don't think about, and a lot of people think of just the bank financing as the debt, but people think about borrowing money from friends, family, mezz financing like that. They consider that equity as well, and that's not equity. So those are probably one of the biggest items to talk all the way through for proper financing.
Okay. So as a GC, we sometimes see clients making the mistake of making a decision based solely on low bid. And I see people talking about rate and, how, they're kind of focused on rate. Is
Yeah.
that a mistake that clients make, or is that what it comes down to? What are some of the other
Yeah.
mistakes that they make?
No. I know it's depressing sometimes.
What's that?
uh, it's depressing sometimes. Yeah. When you yeah, I like to say you get what you pay for. And yes, it is prudent for each and every uh, individual in the process to check costs, right, and to get the best deal for themselves. And sometimes if you just go low bid, low bid, low bid on everything, uh, then something has to give. The old adage is you get it fast, easy, or cheap, but you only get two of the three,
Yeah,
right?
2 out of the 3.
Two out of three. Yeah,
Yeah,
pick which two you want.
yeah,
So yeah, banks are competitive. Banks have to be competitive as far as interest rate goes, but you have to price against risk, right? So in order for the banks and the clients to get the best deal out of it. So I think your question was, we all get low bid, beat up in the process, but it comes down to can you provide the quality and the comfort and the trust level that your client respects. And if
absolutely.
you do, then yeah, if you can, and if you do, then if they don't come to you the first time, they're definitely going to come to you the second time.
Yeah. Any other mistakes that borrowers make when thinking about getting their financing lined up?
Other than not caring about anything but price.
Yeah, yeah,
Yeah, I would just say that it's imperative for the clients to do their proper research, right, to get their ducks in order. One of the biggest issues is, people want to come in and say, I don't want to guarantee anything. I want everything non-recourse. And really all that is saying is I want you to stand behind my project, you, the GC, you, the banker, you, everyone else, but I don't want to stand behind the project. And that's really a mindset that has to change with a lot of owners and developers, in that this is a it's not even a partnership, but it is all parties coming together and agreeing on how they're going to represent themselves in their projects. So I think that's the biggest problem we see up front when projects come through the door, is clients saying, I want, and you have to give me, or I'll go somewhere else. And it really should be more of a full understanding of what the entire process entails and what's equitable and what's just in a
yeah.
deal.
Do
Yeah.
your homework.
You know what?
Okay. Well, Jen, that's a really good overview, and appreciate your thoughts on the topic. Is there any other thoughts you want to add?
I would just say, if I could reach, anyone that's looking into a construction project, is, work with people that you trust, or get to trust people before you dive into a project. I
Hmm.
think that it pays off in spades, because you're going to be seeing these people a lot. You're going to be seeing your GC, your attorney, your banker, your CPA. You're going to be seeing these folks a lot more than you might see your family during
Yeah,
the process. And you really need to, well, it behooves you to find folks that you're comfortable working with, and that you respect and trust.
absolutely,
Yeah,
absolutely.
it makes the world go round.
Okay. So how does somebody get a hold of you, Jen? Is it what's the website, and what's the email address?
So simply Jen Pollock, Pollock, not ACK. You'll never find me at amerisbank.com. Or my cell is 407-704-0993. You can always find me. I don't have banker hours. I have business hours, and my business is when your business is. So yeah, I've enjoyed it for 20 years, and I look forward to the next 20.
Awesome, Jen. Really appreciate you taking the time to share your knowledge and thoughts on the topic. So appreciate it very much.
It's always a pleasure, Bennett. Nice seeing you.
All right. Thank you, Jen.
Bye.